High-frequency trading is not toxic because it is fast. It is toxic because it sees what you intend to do before you do it. This information advantage, not speed, is the real market distortion. We will test this claim with academic models and the SEC's own policy experiment. The public critique of high-frequency trading focuses on speed. The image is of firms with faster cables and closer servers, beating everyone else to the punch. But academic research tells a different story. The real issue is not the speed of execution, but the ability to infer what other market participants are about to do. This is a subtle but crucial distinction. Speed gives you a head start in a race. Information advantage lets you change the race itself. The former is a competitive edge, the latter is a structural distortion. Biais, Foucault and Moinas formalize this in a model where HFT firms observe order flow and update their beliefs about the likelihood that a large institutional trader is active. The key variable is the probability that an order comes from an informed institutional trader. When HFT firms see a series of small orders, they can infer that a large trader is breaking up a big order. This inference is the information advantage. It is not about speed, it is about pattern recognition. Consider a pension fund that wants to buy 1 million shares. It does not place a single order, that would move the price. Instead, it breaks the order into hundreds of small pieces. To a human, these small orders look random. To an HFT algorithm, they form a recognizable pattern. The algorithm sees a series of buy orders of similar size, at regular intervals, and infers that a large buyer is at work. It then adjusts its quotes to profit from this knowledge. This is not speed, it is surveillance. Speed and information advantage are often conflated, but they are fundamentally different. Speed is about reacting faster to public information. Information advantage is about knowing something that is not yet public, in this case, the intentions of other traders. Speed can be neutralized by better infrastructure. Information advantage is more insidious because it exploits the behavior of others. It is not a level playing field, it is a game where one player can read the cards of others. Here is the counterintuitive finding: HFT improves liquidity. Chordia, Roll and Subrahmanyam show that the introduction of HFT reduces bid-ask spreads. That sounds good. But it comes at a cost. The same research finds an increase in noise trading, short-term price fluctuations that reflect order flow randomness, not fundamental information. So we get tighter spreads, but prices become less informative. This is the liquidity-information-efficiency trade-off. It is a central theme in market microstructure. We can formalize the trade-off. The bid-ask spread is a measure of liquidity. It is composed of order processing costs, inventory costs, and adverse selection costs. Adverse selection is the cost of trading with someone who has better information. HFT reduces the spread by reducing inventory and processing costs, but it increases adverse selection because it is better at detecting informed traders. The net effect on information efficiency is negative. The spread narrows, but the price becomes a noisier signal of true value. This chart illustrates the empirical finding. On the left, we see the bid-ask spread before and after HFT. It drops significantly. On the right, we see a measure of noise trading, the variance of price changes not explained by fundamentals. It rises. The two bars tell the story: HFT gives us cheaper trading, but at the cost of a less informative price. This is not a hypothetical, it is what the data show. The SEC's tick size pilot, pushed in 2025 to 2026, is a direct response to this trade-off. The idea is to increase the minimum price increment, or tick size, for certain stocks. A larger tick size makes it harder for HFT firms to jump ahead of each other by fractions of a cent. It reduces their information advantage. But it also increases transaction costs for everyone. The pilot is an experiment. Can we sacrifice a little liquidity to gain information efficiency? The results are still being analyzed, but the debate is central to market regulation. The tick size decision is a trade-off. A smaller tick size reduces transaction costs because it allows finer price granularity. But it also increases the value of speed and information, because HFT firms can compete on sub-penny increments. A larger tick size does the opposite, it raises costs but reduces the HFT advantage. The optimal tick size balances these two forces. The SEC's pilot is an attempt to find that balance empirically. Why does information advantage matter more than speed? Because it affects the fairness of the market. Speed is a physical attribute, you can build faster infrastructure. Information advantage is a behavioral exploit, it preys on the strategies of other traders. It creates a two-tier market, those who can see the order flow and those who cannot. This undermines confidence in the market. If investors believe the game is rigged, they will demand higher returns or leave entirely. That is a systemic risk. The debate over high-frequency trading is not about speed. It is about information. The academic evidence points to a clear trade-off: HFT improves liquidity but degrades information efficiency. The SEC's tick size pilot is an attempt to manage this trade-off. As we move forward, regulators must weigh the benefits of tighter spreads against the costs of a less informative market. The question is not whether HFT is fast, but whether it is fair. We will continue to analyze these issues with data and theory. Markets reward discipline, not certainty. If this analysis helped, like the video and subscribe to DeepQuant. Tell us in the comments which market idea we should test next. Evidence beats noise. Control risk before chasing returns.